Hello traders, welcome to today's webinar. So this will be our final webinar for this workshop, for this series. So before I begin, again, let me know if you can hear me well. Please type 1 in our chat box if you can hear me well. Hello Shailendra at 99. So to answer your question, the winner from our third task can be seen on our Telegram channel. Hello to you as well, home sweet home. I am fine. How, how about you? So by the way, before we start, I want to invite every one of you again to please be part or please subscribe on our YouTube or sorry on our Telegram channel because OctaFX is planning something exciting for all of us inside that channel. So there will be a great opportunity for all of us. So if you are not part of our Telegram channel yet, so this is the perfect opportunity for you to subscribe and be part of that amazing opportunity that OctaFX is brewing. So we will announce that in the near future. So you may find the link on the description box below for you to be able to join on our Telegram channel. Okay, so again to put an emphasis on these things. So if you attended our webinar since the first webinar of this series, so again you will have a chance to get the certificate of attendance. So if you didn't watch the first parts of this webinar yet, so you may find them on our YouTube channel as well as the 100% deposit bonus. So have a chance to double your account. So we will share the promo code again at the end of the lesson. And of course, the $100 giveaway on your own trading account, on your personal trading account. So we already have three tasks, or we already conducted three tasks, and today will be the last task. Obviously, this is the fourth webinar. So you still have the chance to win this $100 giveaway for your live trading account. And of course, the trader's guidebook in PDF format. So we also sent on our Telegram channel the first three PDF guidebook. So this presentation today will be given as well after this workshop. All right. So let me know again your name and where you are watching today so that we could greet you. Hello, Papu Boy from Pakistan. Hello, Lito Mateo from Tublay Benguet. Hi to you as well, Peter B. Thanks for your kind words, Home Sweet Home. So we are also excited to always bring you more webinars. So maybe in the future we will have more webinar series. So let's see. So again, OctaFX is brewing something exciting, something new inside our Telegram channel. So if they can do that, then I am pretty sure that they will also have more exciting or have more interesting topic for our future webinars. All right, so uh, I know that maybe some of you already know me, but if you are brand new, once again, I am Paul Joseph Mendoza. You can call me PJ or Paul, and I have 6 years of trading experience. Okay, so let's now, I think we can now start with our webinar for today's session. So to begin, what we are going to discuss for today is all about understanding the market structure. So this is very, very important. How to find key levels in the charts, as well as how to look for uh, a good or a possible entry points, as well as a good exit points in the market. And this is the very, very important thing, in my opinion, in trading, which is risk management. Because even if you master your technical analysis, even if you have the right information, the right knowledge on how to read the structure, how to look for key levels, exit and entry and exit points, but if you have a poor risk management, then you won't last long in trading, because risk management is the only holy grail, which I believe in trading, right? So as we all know, understanding market structure is very, very important, because without knowing this information, or without knowing how to look on a market structure, then it will be very, very difficult for you to trade, right? Because it's just like wandering on a dark tunnel without seeing any light. But once you understand how to look for this, how to look for key levels, as well as know when to enter and exit your trade, then it will be much simpler and easier for you to make an informed trading decision. Okay, so to begin with that, so understanding the market structure helps you understand and define the current market condition, such as the trend and the dynamics of it. This will give you the buying or selling opportunity. So at this step, you need to decide which trend is happening. So again, before opening a trade, we all need to look for our CEST. So if you remember this one, so C stands for condition, E stands for entry, then S stands for stop loss, then stands for TP, or take profit or target. Okay? So before opening a single trade, all we need to do is to look for the condition of the market first, such as chart patterns, such as the trend. Is it uptrend? Is it downtrend? Or is it just moving sideways? Then some touch of fundamental analysis. And this is very, very important in trading, because without knowing what's happening in the real world, it will sometimes it will lead you to bad trades, right? Because even if you master your technical analysis, but you don't know that there is a high impact news coming in 5 minutes, then it will cost you a lot if you chose the wrong trade, right? Without knowing the at least some basic knowledge of the fundamental analysis. And of course, we can also use trend indicators, such as moving averages. Okay, so to make this simple, so all we have to do is to look first for chart patterns. So for example, you have a downtrend, or you have an uptrend, and then you want to trade with the trend, then all you have to do is to look for chart patterns, such as the triangle that we discussed last time. So for example, we have this uptrend, and then the price started to move like this, so we can draw our trend line for our triangle. And then once we saw a breakout either from this trend line or from this previous high, then that's the perfect opportunity for us to look for for a buying opportunity. Okay, so let's try applying all of the information so far that we are discussing. So first, again, all we have to do is to look for CEST. Okay, so first, C stands for condition. So what we need to do, the first thing, the very important thing to remember is always look for a trend. Okay, because there's a saying in trading that the trend is your friend. And I believe in my 6 years of experience, that is very, very true. If you are trading with the trend, then half of the battle has already won. So in this case, so let's say here on Aussie Canada, so what do you think the trend is? What trend do you think the Aussie Canada is doing now? Is it uptrend, downtrend, or sideways? So what do you think? Hi to you as well, Google Raj. Hello to you as well, Rebecca. Okay, again, what do you think the Aussie Canada is doing now? Is it uptrend or downtrend? You can freely comment on our chat box. So by the way, for you to be able to look on the current market condition, all you have to do is to zoom out your chart like this. Okay, because once again, what we need to do is to first look for a condition, right? So in this case, we can clearly see that the recent price action beginning in this level or in this section of the chart, it is going up, right? So we can clearly see that we have higher highs and lows right here. So this is the very, very important, or the very, very first thing, the most important thing in trading is we need to identify which market condition we are in right now, right? So to follow with this framework, first is we need to look for the chart patterns, trends, and ranges. So we already know that the price of the Aussie Canada came from an uptrend, right? But so far, right now, we can see that the price already created this long pullback, right? So if we compare this pullback that we have right here into this pullback, this is a very, very long pullback. And this is not healthy, right? If we want to look for a buying opportunity, then this is not a good pullback at all, because this pullback is very, very long compared to this previous impulsive move, right? And we can also see that the price is already testing this previous low, and the price in fact already broke it with this candle right here. So having this right information, so we all know that the condition of the Aussie Canada pair right now is moving, or the momentum of the price action for the Aussie Canada right now is down, right? So if you said downtrend, then you may be correct. If you said after uptrend, there's still a chance that the price could go up. So nothing, or no right or wrong answer, because as we can see, the price again, with what we are looking before opening a trade again is condition, right? So we all know that the condition of the price action for the Aussie Canada as of today is a downtrend, right? We are seeing some momentum to the downside, because again, what we can see here is a previous uptrend. Then right now, the price already broke this previous low. So our rule for determining a reversal is once the price breaks this previous low, then this is a sign that the price could go down. Okay? And then as we can see, based on our lesson for today, we are looking for chart patterns. So we already identified the trend, which is a possible downtrend. So now what we are going to look is the chart pattern. And if we are going to check this one out right now, we can see that we have a double bottom here, right? We have the double bottom here, and this previous support is now acting as a resistance. So in this case, what we can do, so again, we all know the condition. The condition is a possible downtrend or the momentum is down. And then the chart pattern so far is we have a downtrend here. We can also draw a zone into it. And then we are now, the price is now sitting on this previous support, which is now acting as a resistance. And we can see we have some entry candlestick patterns right here, and we are going to discuss that later. So again, the first thing that we need to remember is the condition. Okay, so the CEST, C stands for condition, and the condition right now is the price is going down. All right. So moving on, now that we know what to look for, first is to look for a condition. The thing that we need to remember the next thing that we need to do is to identify such key levels. Okay, so we all know that the trend of the Aussie Canada is down, or the momentum is down. We can also draw some trend lines, and if we connect the trend lines, we can see that we have a series of lower highs and lows right here before the breakout of this trend line. So that's the condition first. Identify the market structure and identify the trend. So right now, what we are going to discuss is all about key levels. And for you to be able to identify which level is an important zone or an important level in the chart, we can use trend lines like what we did right here. So all we have to do is to connect two to three highs, such as this one. As we can see, we have three touches first from this high, then the price created the lower high, and then the price created another lower high right here before creating this double bottom. Okay, so we can see that the first important level on the chart is right here with this trend line. And then we can also use moving average. So if we open our 20 period moving average, we can see that the price already broke this 20 EMA. So we can see the price is respecting it right here. Once the price is, or when the price is creating higher highs and lows, the price is consistently bouncing off of this level. And then as we can see, the price goes below this trend line or this moving average. And the same thing happens again. The price is respecting this MA. As we can see, every time that the price action is touching this MA, we can see that it is consistently going down. So we can see that the price goes down, and then it touched the moving average, and then it goes down further, creating a double or creating a lower low, and then the price went back up again, and then it goes back down after reaching this moving average again, right? So this is the first thing that we can do, is to first look for the EMA. So if we look on other examples, so we can also see that we have a trading opportunity right here. So the price went up, it breaks this previous high, and then the price pulled back, and then as we can see, the price reached this EMA right here. So this is the first key level on the chart, is to first look on your indicator. In this case, we are using 20 period exponential moving average. So this is a dynamic support and resistance combined with structure. Okay, so as we can see, the price was able to break this previous resistance. The price pulled back into it. The price didn't respected this resistance to become a new support, because as we can see, the price breached it. The price breached this level with this red candle right here. But we have this dynamic support, which is our 20 EMA. And then as we can see, after going slightly below this EMA, the price created this engulfing candle right here. Okay, so this is the first key level that we can look on a chart. And if you are a beginner, then this trading with moving averages could be very useful for you. Because at first, I know it is difficult for you to look for a structure like a chart pattern, such as the 1, 2, 3 pattern that we already discussed, such as this one. I know what it feels like to trade for a beginner, and I know what it feels to, and I know how confusing it is to look for a chart pattern such as this one, right? So the first thing that you can do is to first look for a possible buying opportunity near our moving average. So in this example, I am using 20 EMA. So you may use simple moving average. So we can also do it like this. So we can change EMA to SMA. And as we can see, let's take a look if the MA change its behavior. So let me just delete this one. Then let me just open a new one. So in this example, let's try. So here opening a moving average. And then let's just use 20 moving average. Okay, so in this example, as we can see, this is also very useful. So either you choose EMA or SMA, doesn't matter. All of them has their own advantage and cons, or pros and cons, right? So it's just a matter of preference. Okay, so again, in this example, we are using an EMA or an SMA for key levels in the chart. So all you have to do is to identify the trend. So in this example, let's say we are just right here right now, and if we look onto this chart, onto this price action, we can clearly see that the price is on an uptrend, right? So that's the first thing that we need to remember. Identify the trend and then look for your key levels. So after identifying the trend, then you may then move on to looking for your key levels on the chart. So again, moving average is one of the key levels that we can use. So if the price pull back into this EMA, then that could be an entry opportunity for us, just like what we have right here. So as we can see, the price breaks this previous high, and then the price, after creating this impulsive move, the price pull back, and then as we can see, the price goes up again for the continuation of this uptrend. Then as we can see, the price just goes below the EMA. This is very normal, but if the trend is strong, we can also see that the price can't breach the moving average like this. So in this case, this is a good opportunity for a bounce. So for example, we have a breakout from this previous high, and then the price pulled back, and then as we can see, the price created this engulfing candle, which is a good entry. And then we can see that the price created a continuation to the upside, and then the price pulled back again, and then we have another engulfing candle right here, which is another possible entry, and then the price continued to go even higher. Okay, so again, moving average is the first key levels that we can use, especially if you are a beginner. Okay, and then we can also use trend lines. So in this example, let's just say, so let me just draw the pattern. So again, we all know the 1, 2, 3 pattern, right? So for you to be able to use a trend line, so you may want to connect 1 to 2 swing lows in an uptrend. But if you are on a downtrend, then look for your highs. Okay, so a series of lower highs is a very, very important thing to look for when trading a downtrend market structure. Then if you are downtrend if you are trading an uptrend, then look for your higher lows. If you can identify at least 2 swings, then that's an important level, and that's a key level on a trend line. So in this case, we can see on our Aussie Canada, if we combine the moving average together with the trend line, so combining all of the things that we learned so far, so we can see that this trend line right here was is has a great confluence with a moving average. So in this case, this is a good key levels on the chart. So if the price could continue making a lower low, so first we need to see a breakout from this low. Okay, so let's say, assuming that the price continue to go down, and then we can expect that the moving average will follow, and then together with this trend line, then we can expect for the price to pull back into this level. So this is the key level, the first two key levels on this pair, which is the Aussie Canada. So first is we have this moving average, and then we have this trend line. So if the price pull back, and if we can have an entry information or entry candlestick pattern, entry pattern such as a candlestick pattern or a price action pattern on a lower time frame, then this is a good opportunity for us to look for a selling opportunity for a possible continuation to the downside. Okay, so again, the first two key levels on the chart is trend lines and moving average. So we can use this two to look for a possible entry. Okay, and then we can also use Fibonacci retracement. So in my personal trading, so this is very useful for me, and this is one of my favorite tool, which is the Fibonacci retracement. So let's take a look at this one. So in this example, so let me just turn off the MA. So in this example, we have this 1, 2, 3 pattern. So assuming that we are just right here. So we have this 1, 2, 3 pattern, right? So we all know that the price could potentially pull back either from this previous support that could turn into resistance, or we can also use Fibonacci retracement, and we can see that this previous support is lining up with this 61.8 Fibonacci level. Okay, so this 61.8 Fibonacci level is what we call the golden zone. Okay, so if we play this one, so what we just need to do is to look for a possible entry from this 61.8 Fibonacci level, or we can also look for the 78.6 Fibonacci level, which is right here. So we can put our zone like this, and if we can have again an entry, then that's a good opportunity for us to look for a selling opportunity. In this case, we have a downtrend. Okay, so there, as we can see, the price is now sitting on this resistance zone, and as we can see, after reaching this golden zone Fibonacci level, which is the 61.8, so as we can see right here, the price reached it, and then the price created this engulfing candle, this red candle right here. So this is an opportunity to look for a sell trade. Then after this one, we can see that the price goes down. Okay, so we have another retest here, which could give us another opportunity. So let's take a look at this one. So if we took this trade, so assuming that we took this trade from this engulfing candle, so we can put our stop loss just above our entry candle. So in this case, let's put it right here, and then let's aim for this previous low. So as you can see, we clearly reach our target right here. So this is the importance of learning how to look for your key levels on the chart. Okay, so again, what we did here is we identified the we identify the trend, right? So if you don't know how to identify the trend yet, so you may use your EMA. So once the price created a 1, 2, 3 pattern below the EMA, just like this, then this is a clear downtrend, or we are now entering the downtrend market structure, because we can see that we came from this long downtrend here. The market is consistently making lower highs and lows, right? So, and then as we can see, the price tried to make a reversal right here, creating a higher high and low, but then the price goes back down again, and then it breaks this previous low that we have right here, which is our previous two. If you remember, based on our previous webinars, okay, then as we can see, the price created another 1, 2, 3 pattern to the downside. Okay, so let me just put an emphasis to this one for those who are brand new. So 1, 2, 3 pattern consists of a pattern like this. So first, you need to identify your highs and then your lows. And then once the price created a swing like this, so this will be your lower high. And if the price created a continuation to the downside, then this will be your lower low. Okay, so you have your high right here, a lower high, a low, and a lower low. And this is the completion of our 1, 2, 3 pattern. Okay, then what you can do is to look for a possible pullback from your previous support or your previous one, which is right here. So once the price pull back into it, then we can expect a possible continuation to the downside. Or we can also use our Fibonacci tool. So if we use our Fibonacci tool, so we can see that our golden Fibonacci ratio, which is the 61.8 and the 78.6 Fibonacci levels, are way up here. So we can put a zone into it for a resistance zone. And then if the price goes up into this level, then we can expect a possible continuation to the downside. Okay, so I hope you learned something new. Abhishek Kumar. Alright, so to continue with this example, so as we can see, this 1, 2, 3 pattern here happened with this price action right here. And then if we forward this candlestick like what we saw earlier, we can clearly see that the price reached the 61.8 Fibonacci level with this candle, and we can see that this is a good entry for us to look for a selling opportunity right after reaching the 61.8 Fibonacci level. And then as we can see, if we took a sell trade here and then making this previous low as our target, so we can clearly see that the price easily reach our target down here. Okay, so that's how we can use the trend. That's how we can take advantage of the trend and the key levels for a possible entry in our market structure. Okay, so for an uptrend, let's take a look for a good example for an uptrend. So this one is good. So we can see that here in this level or in this section, we have this 1, 2, 3 pattern to the upside. So as we can see, we came from this downtrend again. So we have a series of lower highs and lows. Then as we can see, after breaking this previous resistance, we can see that the price created a new 1, 2, 3 pattern to the upside. Okay, so again, we can use our Fibonacci retracement, and then we can look for a possible pullback into this golden Fibonacci zone. And then if we forward, we can see that there we saw a retest from the 61.8 Fibonacci level, and as we can see, this is another engulfing candle. And before this engulfing candle, we have the spin bar, and this is also a good opportunity for us to look for a long trade. So putting our stop loss just below our entry candlestick pattern. So we can see that so let's say we are aiming for at least a 1:1 risk to reward ratio. So moving forward, we can see that the price nearly reached our stop loss right here before going up. And in fact, we already reached our target right here, just right after buying into this pin bar. Okay, so later we are going to discuss how to identify a possible placement for our stop loss. Okay, so in this example, we can see that we just put our stop loss right here, but later we are going to discuss how to look for a better placement for our stop loss using the ATR indicator. Okay, so that's the first three key levels that we can use. Again, first is this moving average, and then the trend line, and then we can also use the Fibonacci retracement. And then, of course, we can always use support and resistance. So for you to be able to find the simplest or for you to have the simplest approach on looking for a support and resistance, all you have to do is to, again, identify your pattern, such as your 1, 2, 3 pattern, and your previous one, which is right here. So again, this is your 1, this is your 2, and this is your 3, right? So this previous one, which is our resistance, because as we can see, the price stopped going up after reaching this level. The price created its first pullback. So this level right here, this previous resistance once broken with the price. So as we can see, the price broke it with this third move. So if the price pulled back, this previous resistance could now act as a new support. So we can always rely on these levels to look for our entry opportunity or for our key levels on the chart. Okay, and like what I said, I am a very fan of using Fibonacci retracement. And if you are not comfortable taking a trade based on the previous one, such as this one, then you may opt in using the Fibonacci retracement. All right. So moving on. So by the way, before moving on, we can also see that based on our framework, we can also look for some key elements of fundamental analysis. And the beauty of this one is we can always look into these three circles right here. So as you can see, for the CAD pairs or for the Canadian dollar pairs, there's unemployment rate that will be announced, and the forecast is 5.1. So we all know that if the actual release is greater than 5.1, then the price of the CAD pairs or the Canadian pairs, especially here on Aussie Canada, this could go up if the price or if the actual forecast goes up to 5.1. Okay, because unemployment rate is a negative news. If there's a high unemployment rate in Canada later, so as we can see, this will be released later at 8:30 Manila time, if I'm not mistaken. Okay, then if the actual rate of the unemployment rate for the CAD is higher than 5.1, then we can expect for the Aussie Canada to go up. And then as we can see, we are just at 7:40 p.m. as of this moment, and we can already see that the price is trying to go above this previous resistance or this previous swing high right here. So let me just if we are going to analyze this one right now, combining with this fundamental analysis in CAD or in Canadian dollar. So again, we are on the Aussie dollar against Canadian dollar. So this is also helpful for you to look for a trade using this information on fundamental analysis. So again, if the unemployment rate goes above 5.1, then we can expect for this one to break this resistance, and we can expect for the price to go up. And we can take advantage of this one on lower time frames such as 5 minutes and 15-minute time frame. Okay, so here as we can see, the price is just moving sideways on our intraday time frame. So let's wait later. All right, so moving on. So we already discussed how to look for key levels and the trends. So now the question is how to look for a candlestick confirmation or an entry candlestick pattern such as pin bar or a doji that we discussed earlier. Okay, so let's go back into our chart. So here in this example that we used earlier, so we identified a key level right here on the Fibonacci retracement, right? And then what candlestick pattern we can use? So based on my experience, every time that I am seeing a pin bar and an engulfing candle such as this one, then the probability for the price to go down is higher. Okay, and this example, we can see that we have this engulfing candle right here, and because of that, we can see that the price goes down up to this level before creating another retest. And then as we can see, the price, so after the price successfully breaks this previous low, so the price breaks this previous low with this candle, then the price created another retest from our Fibonacci retracement, and then we have another rejection right here. As we can see, after pulling back into this Fibonacci zone, the price rejected it with this wick, and then we have this pin bar right here. So this is another opportunity for us to look for a selling opportunity, because as we can see, this is a clear pin bar. Okay, so if we took a sell trade here, then obviously we can clearly see that we also won with this trade because the price went down up to this level before creating this double bottom. Okay, so that's how we can use entry. So again, we already discussed the condition, and then we are now discussing the entry pattern. Okay, so let's take a look at other examples. So here we have another pin bar right here. As you can see, the price breaks this previous low, then the price pulled back into it. So this is what we are discussing earlier. So this previous support is now acting as a resistance right here, and then we can clearly see that we have this pin bar, or other traders are calling this an inverse hammer, an inverted hammer. So putting our sell trade here or taking our sell trade here, then putting our stop loss above our entry. And if we aim for our previous low, so we can clearly see that we easily reach our target down here. Okay, so we can also use price action pattern on our lower time frame. So for example, here for our example here, which is the short trade. So again, we saw the selling opportunity right here on this engulfing candle on the daily time frame. But let's say, for example, we took this trade on the 1 hour time frame. Okay, so going down on our 1 hour time frame, so this is what it looks inside the 1 hour time frame. So for this one, we can see that we can also see some patterns such as this one. So we have this pin bar, and we also have a doji. So this one, the candlestick that looks like a cross is what we call a doji. And we can also use a price action pattern such as a breakout of trend line. So in this case, so we don't have a clear swing highs and lows right here, but let's assume that this is a higher high and low. So if we use a breakout from this trend line, or if we can also use a breakout from our previous low right here, so we can also use this one as a trading opportunity. And then if you took this breakout trade, then we can also see that this is another winning trade for you if you use your intraday time frame. Okay, so that's how we can combine higher and lower time frame. All right, and then finally for our exit points, so we can use the previous swing highs and lows. So again, if we have a downtrend and then if the price pulled back, so let's say we have our Fibonacci retracement right here. So obviously you will put your entry right here, and then for your exit, so you can target your previous low. In this case, we are on a downtrend, so you can target your previous low, which is right here. So if the price goes down from this previous level of support, then you can exit your trade. And you can also use a default setting or your preferred stop loss and take profit, such as the risk to reward ratio. So the very basic thing to remember is 1:1 risk to reward ratio should be our minimum risk to reward ratio that we are using. Or we can also use 1:1.5 or 1:2 risk to reward ratio. So what I'm trying to say here is if you are risking 1%, then you are also aiming for a 1% return. If you are risking 1% right here, then you are aiming for a 1.5% return. And if you are, again, risking 1% right here, then you are aiming for a 2% return. So that every time you are losing 1%, but if you won with your next trade, then you will offset your loss and you will even profit because your return is higher. Okay, so that's how we can use risk to reward the ratio. So in this example, so let's say we took a long trade right here with this uptrend. So using our Fibonacci retracement, so we can see that the price created a support right here on the 78.6. The price gave us the spin bar. So let's say we put our entry here, or we took our entry here and putting our stop loss down here. So let's say we put our target for a 1:1 risk to reward ratio, then the trade will look like this. If we want to use 1:1.5, then all you have to do is to look into this indicator. So as you can see, we have 1.51 right here. So this is good. But keep in mind that if you are increasing your return, then your win rate will be much lower because the target is much farther than your stop loss. Okay, so that's very normal in trading. It's just a matter of preference. Okay. So again, before moving on our risk management point, what we learned so far is the market structure, such as the 1, 2, 3 pattern, and then key levels, the Fibonacci retracement, the support, resistance, the trend lines, and the moving average, entry and exit points, such as the multi-time frame and the candlestick patterns, and then the exit point, such as the fixed risk to reward ratio and the previous swing highs and lows. Okay, so I'm sorry if we are being so fast because we just have a limited time. So now we are going to discuss risk management. So risk management is, I believe, the most important thing in trading because this will help you play the long game. Because remember, in trading, it is not important to win every time. What what important in trading, what's important is that you remain consistent with your action, because consistent action will give you consistent result. Okay? So, risk management involves identifying, accepting, and mitigating trading decision uncertainty, because we all know that there's no 100% win rate, right? Even the most successful traders out there are just aiming for at least 50 to 60% win rate. If they have 50 to 60% win rate, they will be very happy, because most of the time, successful traders only have 50 to 40 to 50% win rate. They are just managing the risk well, and that's why they were able to play the long game. Okay, because like what I showed you last time, so let me reiterate on this one. Like what I showed you last time, you won't win all the time. So in this case, as you can see, yes, it's very possible to have this win streak, but it is also possible to experience some losing streak. So remember, if you risk 10% per trade right here, so this is 3 losing streak, then this will give you a 30% loss, right? So that's why it's very important to always risk a reasonable amount of risk. So in this example, we can see that the golden rule for most traders is just 1 to 2%. So as we can see right here, the golden rule for trading is 2% or less per trade. Okay? Because for example, you won with your trade, and then you won again with your trade. But for the third time, so let's say you put 1% risk right here, then you gain 1%, and then you again gain 1%. But on your third trade, because you are now thinking that the price is always giving you wins, then you increase your win rate on your third trade, or you increase your risk on your third trade. Instead of just risking 1, you increase your risk to 5. So even if you win 2% right here, then if you lost 5% on your third trade, then it will cost you 3%, right? It will cost you, or the return on your portfolio will be negative 3% instead of just losing 1% on this specific trade alone right here. Okay, so this is the important thing in risk management. So always remember that there's no guarantee in trading, because we all know that trading is risky, right? So any business out there is a risky business, because we all know that there's no holy grail. The only holy grail in trading is risk management. So that's why it's very, very important to keep your risk management intact. Okay, so again, right here, we can see that proper risk management will minimize your losses and keep you in the market longer. So this is what I am trying to say earlier. Always play the long game. Okay, or always aim for consistency. Okay, instead of aiming for a jackpot trade, aim for a consistency. Okay, so risk management tips. So get an adequate, for you to be able to have risk management intact on your trading, or for you to be able to practice risk management well in your trading. So first, you need to get an adequate knowledge of Forex market and its risk before trading. Because again, we all know that Forex or trading in general is risky. There's always risk involved. So that's why it's very, very important to get an adequate knowledge of Forex. And then backtest your strategy on your demo account before trading on a real account. So this is the good thing in OctaFX. They are offering a demo account. So let me just show you what I am saying. So here, as you can see, this is a demo account on OctaFX. So you can practice your trading here. So for example, here on the Aussie Canada, so let's say we want to buy. So by the way, let me show you how to identify an important placement for your stop loss. So for example, here we use Fibonacci retracement, and then as we can see, the price clearly reached this 61.8 Fibonacci level, right? So for you to be able to identify your right placement for your stop loss, all you have to do is to use your ATR. Okay, so for you to be able to pull up your ATR on your chart, so just click indicator and then type ATR and then click average true range, and then this indicator will appear. And then just hover your mouse on your entry candle. So in this example, let's just say we put our entry here on this candlestick right here. So just just hover your mouse into it, and then we can see that our ATR right here, if you look into this ATR, we can see that it has 0.00903 ATR value. So all we have to do is to copy it. So beginning on your support, so copy the 0.00903. So 0.00903 will be right here. So you can go above 903, but you can't go below. So as we can see, we have 00916. Okay, so once identified, then what we can do is to put our stop loss right in this level. Okay, so now that we know where to put our stop loss, then we can buy into this level, and then you can put your stop loss right here. And then for your target, again, you can aim for this previous high that we have right here. And if you put your entry here, so we can see that we will have a 1:1.46 risk to reward ratio. So your risk down here is 1%, and your reward, if you won with this trade, will be 1.46%. Okay, and if you are asking how to calculate for my lot size, because we need to put our lot size here. Okay, so in this example, let's say we want to take a sell trade because the price is now sitting on this resistance zone, and then we can see that the price is now creating a pin bar right here, right? So in case you want to sell, to take a short trade, so we need to identify our lot size first. Okay, so for you to be able to do it, all you need to do first is to know how much capital you have. So in this case, we have 4913 or $4,913. So go on to my FX book calculator, and then your currency pair is Aussie Canada. Just type it right here. And then for our account size, again, we have 4913. So put it right here, 4913. And then for our risk, again, aim for at least 1% per trade. And then for our stop loss, so if we look into this one right now, so assuming that the price could go down on this resistance zone, so hover your mouse on your entry candlestick pattern. So we can see that we have 00675. So again, pull up your tool or this price range tool. So again, the ATR is 00675. So it will be right above here. And then so let's say we want to take a sell trade right now. So we can put our stop loss right here based on our ATR. And then for our take profit level, so let's say we want to put it on our previous low, which is right here. So in this case, we will have 1:1.47 risk to reward ratio. Okay, so in this case, we know now that our stop loss is 78.4. Okay, right here. So 78.4 pips. So put it right here. So 78.4. So once identified, just click calculate, and then our lot size will be 0.08 lot size right here. Okay, so you can now put it right here, 0.08, and then just click sell. And then as we can see, the price automatically open our trade, and we can see that our trade is open right here on our terminal. All right. And then if you want to put your stop loss, then just drag it. So remember, our stop loss is 78.4. So just drag it up to 78.4. Or you can just double click SL right here. Okay, so click SL. double click SL right here. And then here on level, you can put your stop loss, which is 78.4. So again, remember in trading or in MT4, 78.4 is 784. Okay? So just remove the dot or the point. And then for your TP, so our TP will be placed right into our previous low. So in this case, our TP is 115.1 pips. As we can see right here, we have 115.1. Okay, as we can see right here. All right. So just put it right here, 115.1. Okay, and then just enter, or you can always just drag it right here if you want, if you prefer to. Okay, so there, as we can see, the trade is now on place. So again, our stop loss is 78.4 while our TP is 115.1. Okay, so that's how we can place a trade on our MT4. All right, so to continue with this one, so first understand or get an adequate knowledge, and then backtest your strategy. Then understand also the impact of the leverage. So we already discussed the leverage. Then work on your risk appetite. So if you are not comfortable risking 2%, then just risk 1%. If you are not comfortable losing 1% per trade, then just use 0.5%. So I am also practicing that 0.5% risk on my personal trading. And then use a moderate position size. So just like what we did earlier, we identified how to calculate for our position size on my FX book. Okay, and then set preferred stop loss and take profit levels on your trades, just like what we did on our MT4. And then choose a moderate risk to reward ratio. So you can aim for at least 1:1 risk to reward ratio. Okay, and then this is very important as well. You can always use a trailing stop loss. So for example, we have an uptrend. If you bought into this previous resistance, so let's say the price goes up and you put your stop loss here. So every time that the price is creating a new low, then you can put your stop loss just below that new low. So for you to be able to profit more. So let's say the price is continually making new lows, and then once the price breaks this low, then you can then exit your position. All right, and then this is very important. Control your emotion. Don't overtrade or revenge trade, because emotion will have a huge impact on your trades. Because if you are too emotional, then it will be difficult for you to be a consistently profitable trader. Then of course, always know when to stop after consecutive wins. So let's say your daily target is to just have 2 trades per day. Then if you won with those 2 trades, then you can stop trading at all. And then never risk more than 2%. So the maximum risk that you should take is 2%. All right. So to wrap up with this session, so what we learned for our webinar today is the market structure, such as the uptrend or the downtrend, how to look for the patterns, and then key levels, the Fibonacci retracement, the trend lines, as well as the moving average, and the support and resistance, and of course the entry points such as the pin bar, the engulfing candle, or the price action pattern that we learned last time, such as the head and shoulder. Let me just draw it again. That's a bad head and shoulder pattern. Head and shoulder. We also have a double top. So we learned this last time. We also have double bottom. So something like that. So for exit points, you can target your previous swing highs or lows, or you can always use a fixed risk to reward ratio, such as 1:1 risk to reward level. And then again, practice a proper risk management. All right. So having said all of those things, So we can now move on our Q&A. So if you have some question, you can ask on our chat box. And again, for you to be able to take advantage of our 100% deposit bonus, you may use this promo code, which is PaulJM100. So again, this promo code is valid until May 31, 2023 only. So you may want to deposit before May 31 for you to be able to take advantage of this amazing opportunity, which is 100% deposit bonus just by using this promo code. Okay. So again, if you have some question, you can now freely put your questions on our live chat. Hello, Nirav Patel. So one of my strategy that I am always using is the 1 2 3 pattern. So first, what I am always doing is identify the 1 2 3 pattern. So in this case, in Aussie Canada, so let's say if I'm going to analyze this one right now, so we have this one and then we have this two, but we don't have the three yet, right? Because we have a double bottom right here. So in this case, what I am normally doing is I will wait for the breakout of this previous low for me to have a completion of my 1 2 3 pattern. Then once the price breaks this level, I will then wait for a pullback to this previous support for a possible resistance, and then I will look for an entry candlestick pattern or a price action pattern for a possible continuation to the downside. So that's how I am normally doing my daily trades. The red engulfing candle, if you are on a downtrend, so let's say you are on a downtrend and then the price, so let's say the price pull back on your previous support, and then it acts as a new resistance. So for us to have uh, uh, a good entry candlestick pattern, so let's say we have this green candle right here, and then we have an engulfing candle up next. So the engulfing candle should be bigger than the previous red candle like that. Okay. So in case you saw this, so this is a good engulfing candle. So all we have to remember is the engulfing candle should close below this green candle. So once you saw this, then this is a good opportunity for us to look for a selling opportunity. Okay. Hello, Home Sweet Home. So I don't know yet when will be the next webinar, but thank you so much for always anticipating our next webinar. That's good news if you were able to buy a new phone using your profit from your Forex account because of our webinar. So I am very glad that we are able to bring value to you. So expect more in the future to have more webinar series with me. And again, we have something new inside our Telegram channel. So in case you are not a part of that channel, so this is the perfect timing for you or the perfect opportunity for you to subscribe on our Telegram channel. Yes, Nirav Patel, everything that we learned today is applicable on any time frame. Whether you are trading on the 5-minute time frame, whether you are trading on the 15-minute time frame, everything that we learned today is applicable. Okay, so let me show you one of my recent trades. So here on Aussie Yen, so I use the 1 2 3 pattern on it. So if I'm not mistaken, I showed this last time. Uh, if I'm not mistaken, this is the trade that I took. So as we can see, we have this 1, 2, 3 pattern on the 5-minute time frame. Then the price pullback. And if we use our Fibonacci tool, we can see that the price pullback on the golden zone, right? And I saw a pin bar right here. So this green candle right here is obviously a pin bar. So this is where I took my buy trade. Then I use my ATR to identify the right placement for my stop loss. Then as we can see, we can clearly see that the price goes up in my favor. So there, as you can see, even in the 5-minute time frame, this strategy is working. So this is not exclusive on the daily time frame alone. Okay? So any question? So last question before we end. Hello, Papa Boy. Those things are just the same. All right. So if you don't have any question, so once again, I want to thank you for being part of this whole webinar series. So again, if you are not subscribing yet on our Telegram channel, so this is the perfect opportunity for you to subscribe because OctaFX is brewing something exciting, something new for all of us. Okay. So once again, this is Paul Mendoza, your trading speaker. Bye.